Hello my friends, let's move on in chapter 2 and take a closer look at investment companies, i.e. mutual funds. Most of the time you hear the term mutual funds, not investment companies. Okay, what do these companies do? Well, they are companies that issue their own shares and then use the proceeds to purchase stocks and bonds in other companies. These are companies that specialize in investing in other companies, securities in other companies. Okay? Each stockholder in a mutual fund, in an investment company, owns a pro rata share of the portfolio. So the company issues a bunch of shares, and investors pay money for those shares. The money goes into the investment company. The investment company buys stocks and bonds. They create a portfolio, and each investor owns a piece of that portfolio. Okay, instead of owning plant and equipment and people, they own shares in or bonds in other companies. Okay, what do investors get? Well, they get professional management. Hopefully the investment people at these mutual funds know what they're doing and they make smart decisions, smart investment decisions. They get low cost. It's much cheaper and much faster to diversify by buying a mutual fund or an exchange traded fund, which is really a type of mutual fund. Okay, so you get professional management, lower cost, good liquidity, instant diversification, all these things you get from owning a mutual fund. Okay, and there are two ways mutual fund companies can handle purchases and sales following the initial offering of shares. So companies are founded, they offer shares, and then what happens after the initial offering occurs? Well, we have two kinds of companies. We have open-end funds. Now with an open-end mutual fund, every time a person wants to buy into that fund, the open-end fund will sell new shares to the investor. Okay, so it's a transaction done between the investor and the mutual fund company, and the new money comes into the portfolio. Okay, then there is the closed-end fund, and closed-end funds are traded on an exchange. Open-end funds are not. Okay? Open-end funds are direct transactions. They're transactions that are done directly between investors and the company itself, the mutual fund company itself. Let's check the recording here, make sure we're recording, everything looks good. Okay, so with a closed-end company, once the initial offering period is over, the closed-end company does not sell any new shares. Okay? You want to buy into the company, you've got to buy the stock of the closed-end company on the exchange. You're buying from another investor, you're not buying from the mutual fund company. Okay? You're buying directly, you're buying from another investor. Alright, all trades for open-end funds are completed using the net asset value at the end of the day during which the order was submitted. The net asset value is the total value of the portfolio owned by the mutual fund company divided by the number of shares. Okay, that's net asset value. So let's take a look at some of the different types of mutual funds. Money market funds, that's right folks, money market funds are a type of mutual fund. A money market fund is not an insured and guaranteed investment issued by a bank like a CD or savings account or a checking account. A money market fund is not insured, it is not guaranteed, it is a mutual fund. It is a mutual fund that invests in high quality, low risk, short-term instruments. They buy T-bills, CDs, commercial paper, very short term. People park cash in money market funds instead of the T-bills, CDs, and commercial paper. Why? Because you get a decent return, and with one transaction you can put all of your money into one fund, and it's instantly diversified, and a manager, a professional manager, invests the money in T-bills, CDs, and commercial paper, and you, the investor, you don't have to worry about those things. All right. There's no sales commission when you buy into a money market fund or sell out, and very low minimums, usually $250 to $500 to get into a money market fund. And they often have better rates than CDs, so you don't have to lock your money up, get a nice rate of return. So they're a good alternative to a savings account, and you can get them at virtually any bank, any brokerage company, and any mutual fund company, a lot of mutual fund companies. All right, so money market funds, as I said, they are not FDIC insured. You need to know that. All right, let's look at bond funds. Bond funds. They differ by the type of issuer they invest in. We'll take a look at that. By the quality or the security of the bonds they invest in, and by the maturities of the bonds in which they invest. Examples might include an intermediate term, so that's maturity, government, that's the issuer fund, and a high yield junk, which that's quality or lack thereof, corporate, which is a type of issuer, bond fund. So you can see that they differ by the quality, the type, and the maturity. So each fund has a different, what we call a mandate, what they specialize in, and you have to read the fine print to see what you're investing in, okay? Some funds actually use options and futures in an effort to enhance return. You better read the prospectus, because if they use options and futures, it's going to add, typically will add to the risk, so you have to be aware of that. Then we have stock funds. They differ, like bond funds, they differ. They differ by what? By investment style, such as growth or value. We'll get into a detailed discussion of growth and value. That's an investment style. They differ by objective. What are they trying to do? Are they trying to realize a capital gain, or are they trying to generate dividend income? And they differ by size of the stocks in the portfolio. Are they large company stocks or small company stocks? Okay, so what do they specialize in? Okay, they differ by industry or sector. Okay, some specialize in computer hardware, some specialize in computer software, some specialize in food and beverages, some specialize in healthcare. Okay, they specialize by where they look for investments, U.S. or abroad. So man, you can slice and dice in many, many different ways, and there are thousands. There are more mutual funds than there are stocks out there. By asset classification, asset class, stocks or bonds. Okay? By their investment approach, are they active, which means they're trying to beat the market, or are they passive, which means they're trying to match the market? So many different types of investment companies out there. Then we have, let's make sure we don't go too far. Yeah, this is our last clip, clip 42, real estate investment trust. This is a type of investment company, and if you guessed that they specialize in real estate, you guessed correctly. We call them REITs, Real Estate Investment Trust. This is an investment company that invests in real estate, and there are a couple of different types. We have the construction and development trust. Okay, these companies take money in from stockholders, and then they make loans like a bank would to builders during initial construction. You need to know this about how commercial construction, office buildings, retail, apartments, what happens is there are two types of loans that take place. The first type of loan is a construction loan. And obviously, once the construction, so this money is used to build structures. Once the building is complete, then a permanent loan is made to finance the building and land over a long period of time. But the construction loan is a higher risk, shorter term loan. Okay, and so a lot of REITs make these construction loans, but banks make construction and permanent loans. Then we have mortgage trusts. Okay, this is the long term. This is the other type of loan. Once the building is complete, then a mortgage is taken out. Okay, so where do you want to be? Do you want to be on the construction side or on the mortgage side? Okay. Lastly, you have equity trusts, and these real estate investment trusts they have the equity in these projects. So and the different kinds, you can own an office space REIT. You can own a Class A, the nicest office space REIT in the southeast region of the country, or you can buy an apartment REIT in the northwest corner of the United States. So there are lots of REITs out there that enable you to own property where you want to own it. Okay? So a way to own real estate. So apartments, commercial or office buildings, retail. Okay, let's see where we are here. All right. So that's, oh yes, we're done. Clip 42, slide 42, so we're done. And we'll move on to low liquidity investments and a little advice, and we'll be finished with chapter 2. Until then, peace out. Shalom.